Hello everyone, Gianni DePoce here with TheoTrade, and today is the 3rd of September 2024. We are back from the Labor Day holiday, and the markets are definitely making sure that we were paying attention going into the long weekend as we were hit with a straight sell program today here in the shortened trading week. We're seeing tech and the NASDAQ lead the market lower. I have the S&P chart set up here, and I'm going to be very upfront with you. There are some serious technical concerns mounting in this market right now. First and foremost, the fact that we formed a secondary lower high with respect to the all-time high in the S&P just over the last week or so. And so now I'm actually looking for at least another 100 to 150 point drop in the S&P. I'm going to be watching support in the 5,400, 450 zone. And if that holds, it gives the bulls something to work with. But if we break below that zone, then we could be in trouble going into election season and the Fed's first rate cut in just over 2 weeks. But, it is really just a risk-off market right now when you have tech and various chip names leading the market lower. Check out the amount of space in terms of price between these two highs in the NASDAQ from that 22nd of August to that all-time high of July 11th. That's a significant lower high, and it was rejected right there in that resistance zone we had discussed in the $19,800, $20,000 area. Now, I'm looking for potentially a retest of 18,000, 18,500 now in the NASDAQ. If that forms and makes a higher low, similar to the S&P, it will give bulls something to stand on. But as I look at some of the internals this week, or so far this week, I'm a bit concerned. When you have the semiconductor index down over 7%, gapping down and trading near the lows of the day on the first day of the week, that is a problem. When you have NVIDIA, a market moving stock, down 9% on the day, gapping down and trading near the lows of the day, that is a problem. Apple also grappling with a secondary lower high, down 3% from its close last week. That is a problem. So I can go on and on, but I think you get the idea. Meta kind of holding up all right. Google was the other one that I was a little concerned about. You're about to close at a new low there today, and that is not a good sign. Meanwhile, you are seeing nice bids in names related to consumer staples, utilities having a good day, even real estate, basically anything that has to do with a slowing economy and lower interest rates as we see bonds catch a very strong bid. We actually did put on a long bond position in the futures market on Friday, playing that idea of a cyclical bottom in the 10-year note. We do have an upside target of 116, but it's looking more and more like interest rates are going to drop going into at least June of next year based on some various cyclical studies that I've been working on. And so the market is temporarily readjusting to that reality, right? And I think that tech will eventually recover because tech seems to like those low rates environments. But now the question is whether we will get into an economic slowdown or if this liquidity push from the Fed starting in a couple of weeks will be enough to buoy this market higher. We did see biotech start off the day on a good note. Now we're seeing some selling accelerate to the downside, but one of the few bright spots in the portfolio today, rocket companies. This is a name that we've had. We've already captured some positions. United Wholesale Mortgage, one of the company's competitors actually in Michigan as well. That one is down today, but showing a little bit of relative strength compared to the overall market. A slow and steady bid higher we've seen in Intercontinental Exchange, but a lot of financial companies like Berkshire Hathaway, well, actually, that's been quite the reversal, but you have seen some pretty good relative strength in financials. JP Morgan Chase hit a new all-time high on Friday. Wells Fargo managing a small rally so far today, but there are issues underneath the surface of this market. We did share a long idea in Philip Morris International towards the end of last week. This one continues to do the right things and move in the right direction, but it's important in these tapes when you see big sell programs hit the market not to panic because they love to mess with your stop losses. I like to respect my stop losses until the end of the day, but you look at some other risk appetite barometers. Bitcoin and Ethereum had decent weekends, but they're showing a little bit of weakness there. The crypto names Mara, MicroStrategy looking very vulnerable to some further downside in the coming days and weeks, and that's something that should be paid attention to very closely. Gold and silver are both down today, but up off the lows of the day. We'll see if that holds. We still have a long position in on silver. It did come pretty close to testing the stop loss today, but it did manage to hold above that. So I'm optimistic for a rebound in that. I think for the overall market, we need to see the dollar continue to weaken. We're seeing that against the Japanese yen, but maybe not for the right reasons. When you compare that to the euro, the dollar is still appreciating against the euro. The exchange rate is dropping. That usually means that the euro is weakening. And if you look at well, it always means that the euro is weakening. But if you look at the euro against the euro is down against the yen today. So euro weakness has not really been that much of a tailwind for stocks. And so, this is what's different about the rally that we had, or I should say the decline that we had from July into August compared to now, is that the dollar was dropping during that time. And that was one of the big reasons why I wasn't as concerned. But now that we're seeing the dollar rally, you're seeing tech get wrecked, you're seeing the defensive segments of the market outperform. There are still some long-term cyclical concerns that we need to be aware of, and those may be coming to fruition. So it looks like the cash levels are going to be raised today, and that's okay. And then we'll have to reassess if and when we test support in the coming days and weeks. But this is not a market to be pushing the envelope on those growth names. Focus on the setups in the more defensive segments of the market, and that also means recalibrating your reward expectations. You're not going to be getting those big licks, big rallies, and appreciations like you do in growth stocks if you're trading consumer staples. So calibrate your risk reward accordingly, and just let this selling make its way through, flush everything out, and then we'll see how sentiment resets in the coming days and weeks, and try to see if we can make a rally back to new all-time highs in the coming months. So that's all for now, everyone. Thank you so much for watching. Hope to see you in the TheoTrade chat room, as well as the TheoTrade live event in Scottsdale, Arizona. Starts next week on the 12th of September. I will be there, and I look forward to meeting you there, hopefully. Thank you very much.